Good day, gentlemen. Welcome back to Introduction to Financial Accounting 2. Today we are looking into Chapter 11 of your curriculum, which looks into current liabilities and payroll accounting. The learning objectives for today is to first try to explain how to account for current liabilities. 2, we're going to discuss how current liabilities are reported and analyzed. And finally, we're going to look at how to account for payroll. So let's begin with trying to understand what is current liabilities. Current liabilities is basically a debt that a company expects to pay within 1 year or the operating cycle, whichever is longer for that company. So current liabilities include notes payable, accounts payable, unearned revenues, accrued liabilities such as taxes payable, salaries and wages payable, and interest payable. You've covered current liabilities previously in Accounting 1, so this is not a completely new concept for you. Quick question. To be classified as a current liability, a debt must be expected to be paid within 1 year, or B, the operating cycle, C, 2 years, or D, A or B, whichever is longer. So basically, just like what we mentioned in the previous slide, 1 year or the operating cycle, whichever is longer. Now we'll look at some examples of current liabilities. We'll start with notes payable. What is notes payable? Notes payable is basically a written promissory note. This is frequently issued to meet short-term financing needs, and it requires the borrower to pay interest. It is also issued for varying periods. So it could be for a couple of months, 6 months, or a year, and so on. Quick illustration. First National Bank agrees to lend $100,000 on September 1st, 2017. If Cole Williams Company signs a $100,000 12% 4-month note maturing on January 1st, prepare the entry on September 1st, prepare the adjusting entry on December 31st, assuming monthly adjusting entries have not been made, and C, prepare the entry required on January 1st, 2018, which is the maturity date. So the entry on September 1st is going to be recorded as follows. We're going to debit cash account 100,000 and credit notes payable account for 100,000. The adjusting entry on December 31st is going to be to debit interest expense on that promissory note. So we're going to calculate what percent out of the 100,000, but we're going to multiply it by 4 over 12, which is 4 months out of the 12 months total at a single year. So we're debiting interest expense for 1,000 and crediting interest payable. And finally, at the maturity date, we're going to record the following entry. We're going to debit notes payable to close its account for 100,000, and we're going to debit interest payable for 1,000 and credit cash $104,000, which is the total of the promissory notes or the notes payable plus the interest that is paid on top of it. Another current liabilities account is sales taxes payable. Now, sales taxes are expressed as a stated percentage of the sales price. Selling company, retailers in specific, collects tax from the customer, enters the tax separately in cash register or includes it in the total receipts, and remits the collection to the state's Department of Revenue. And you see this currently with VAT, with the value added tax, ضريبة القيمة المضافة. This is pretty much how it's handled. So it is collected by the company or the retailer, and it is included in the receipt most of the time as a percentage of the sale. And then the retailer collects it and they need to pay it to the government, هيئة الزكاة والدخل, at certain points in time. Here's a quick illustration. The March 25th cash register reading for Cooley grocery shows sales of $10,000 and sales taxes of $600 based on the sales tax rate of 6%. So the journal entry is cash debit 10,600 and we credit sales revenue 10,000 and credit sales tax payable for 600. Some companies do not enter sales taxes separately in the cash register, and this illustration shows how it's recorded in that case. Cooley Grocery enters total receipts of 10,600 because the amount received from the sale is equal to the sales price 100% plus 6% of sales, which is the sales tax rate of 6%. The journal entry in that case is cash debit 10,600 and credit sales revenue 10,000 and credit sales tax payable $600. You might also remember from our studies in Accounting 1 when we talked about unearned revenue. Now, unearned revenue is basically a revenue that is received before the company either delivers the goods or provides the service. And unearned revenue and revenue accounts in different types of businesses that usually deal with this kind of liability are airline companies, magazine publisher, and hotels. And now for airline companies, unearned ticket revenue, so they usually get paid before they actually fly their customers from one destination to another. And the revenue in that case is from the sale of the tickets. Magazine publishers also get unearned subscription revenue, and the revenue in this scenario is basically the subscription revenue. Finally, hotels. Usually when you check in into a hotel, you pay before you actually stay the night. So that is an unearned rent revenue, and the source of revenue for that account is rent revenue. Quick illustration. Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. The entry for the sale of season tickets is recorded as follows. Cash is going to be debited for $500,000 and unearned ticket revenue is going to be credited for $500,000. Now, as each game is completed, Superior records the recognition of revenue with the following entry. Unearned ticket revenue debits $100,000 and credit to the ticket revenue account for $100,000. Another type of current liabilities is the current maturities of long-term debt, which is basically the portion of any long-term obligation that comes due within the current year. No adjusting required for this kind of entry. If you look at the illustration here, when the construction issues a 5-year interest-bearing 25,000 note on January 1st, 2017. This note specifies that each January 1st, starting January 1st, 2018, Windy should pay $5,000 of the note when the company prepares financial statements on December 31st, 2017. What amount, or number one, what amount should be reported as a current liability? Of course, it is the current portion of the long-term obligation, so it's $5,000. What amount should be reported as a long-term liability? It's the remaining of the total debt or the total financial obligation, which is $20,000 in this case. Here is a do-it-yourself exercise. It says you and several classmates are studying for the next accounting examination. They ask you to answer the following questions. If cash is borrowed on a $50,000 6-month 12% note on September 1st, how much interest expense would be incurred by December 31st? The solution for this one is basically taking the amount of the note, which is the $50,000, you multiply it by the interest on that note, which is 12%, and then you multiply it by the number of months that expense is going to be incurred on. In this case, it's 4 months because it's starting September, month number 9, September, October, November, and all the way to the end of December. So that is 4 months. So that is why we multiply by 4 over 12. And in that case, you can see that the interest expense that is going to be incurred is going to be $2,000. The second question is, how is the sales tax amount determined when the cash register total includes sales taxes? Well, the solution to this question is that first, we need to divide the total cash register receipts by 100% plus the sales tax percentage to find the sales revenue amount. Second, you need to subtract the sales revenue amount from the total cash register receipts to determine the sales taxes, which is going to be the remaining amount in this case. Third question says, if $15,000 is collected in advance on November 1st for 3 months' rent, what amount of rent revenue should be recognized by December 31st? The solution to this is that we're going to take the dollar amount of the collected rent, which is $15,000, and multiply it by 2 over 3, which is 2 months out of 3 months, and that is going to give us $10,000. Moving on to the second learning objective for today's lecture, we're going to discuss how current liabilities are reported and analyzed. First, we'll talk about reporting uncertainty, and this refers to contingent liability, which is potential liability that may become an actual liability in the future. There are 3 levels of probability in that case. Could be probable, could be reasonably possible, or could be a remote likelihood. In case the contingent liability is probable, accountants of the company may either accrue the liability or record it in the footnotes. In case the contingent liability is reasonably possible, they would put it in the footnotes in the financial reports. But if the contingent liability is remote or unlikely, then they would just ignore it. A quick question says a contingent liability should be recorded in the accounts when A, it is probable the contingency will happen, but the amount cannot be reasonably estimated. B, it is reasonably possible the contingency will happen and the amount can be reasonably estimated. C, it is probable the contingency will happen and the amount can be reasonably estimated. Or D, it is reasonably possible the contingency will happen, but the amount cannot be reasonably estimated. Obviously, the correct answer in this case is C. Only if the contingent liability is probable in its occurrence and the amount can be reasonably estimated, only then we are going to record the contingent liability. Contingent liabilities may include items like product warranties. These are basically promises made by the seller to a buyer to make a good on a deficiency of quantity, quality, or performance in a product. Estimated cost of honoring product warranty contracts should be recognized as an expense in the period in which the sale occurs. Here's an example of how we can estimate product warranties. Denson Manufacturing Company sells 10,000 washers and dryers at an average price of $600 each. The selling price includes a 1-year warranty on parts. Denson expects that 500 units, which is 5%, will be defective and that warranty repair costs will average $80 per unit. In 2017, the company honors warranty contracts on 300 units at a total cost of $24,000. And on December 31st, compute the estimated warranty liability. So what they've done here, they took the number of units sold, which is 10,000. They estimated the rate of defective units, as given in the question, 5%. That gives us a total estimated defective units of 500 units. And the average warranty repair cost of $80. So multiplying those two figures, we'll get the estimated product warranty liability of $40,000. Now, how do we report this on the General Journal? In that scenario, the estimated warranty liability will be recorded in the journal by debiting the warranty expense, 40,000, and crediting warranty liability of the same amount. But then notice that the company have actually paid only 24,000 for repairs. So we need to prepare the entry to record the repair costs incurred in 2017 to honor warranty contracts on 2017 sales. So notice what we've done here. We've reversed the credit we created earlier to warranty liability to a debit with the actual paid amount of 24,000, and we're going to credit repair parts for the same amount. Now assume that the company replaces 20 defective units in January 2018 at an average cost of $80 in parts and labor. So in that case, again, we're going to debit warranty liability for the multiplication result of the 20 by 80, which is 1,600, and we're going to credit repair parts. Now here we have a balance sheet for a company called Even Company as of December 31st, 2017. And you notice how current liabilities are reported on the balance sheet under the Liabilities and Owner's Equity section. You see current liabilities in front of you in the red color. Now, how do we analyze current liabilities? We have multiple ways of doing that. The most commonly used metrics are working capital and current ratio. Now, working capital is designed to measure liquidity of the company, which refers to the ability of the company to pay maturing obligations and meet unexpected needs for cash. How do we calculate working capital? We basically subtract current liabilities from current assets, which will give us the working capital. Whereas for current ratio, it basically permits us to compare the liquidity of different sized companies and of a single company at different times. So it kind of ignores the size differences when you're analyzing different companies of different sizes. How do we measure it? We basically divide current assets by current liabilities, and it gives us the current ratio of a company. Here we have a do-it-yourself exercise that covers reporting and analyzing current liabilities. So let's go over it together. It says Lipid Company has the following account balances at December 31st, 2017. They have notes payable of 80,000 due after the end of December 2018, 200,000 unearned service revenue of $75,000, other long-term debt 30,000 due in 2018, 150,000, salaries and wages payable 22,000, other accrued expenses 15,000, and accounts payable of 100,000. In addition, Lipid is involved in a lawsuit. Legal counsel feels it is probable Lipid will pay damages of 38,000 in 2018. A. Prepare the current liabilities section of Lipid's December 31st, 2017 balance sheet. And B. Lipid's current assets are 504,000. Compute Lipid's working capital and current ratio. For the first requirement, as you can see, we're going to prepare the current liabilities section of Lipid Company as on December 31st, 2017. And the current liabilities here would include the notes payable, or the current portion of the notes payable and accounts payable, unearned service revenue of 75,000, the lawsuit liability, because we said that it is probable and the amount is or could be estimated, salaries and wages payable, other accrued expenses, and long-term debt due within 1 year, so the current portion of the long-term financial obligation. And as you can see, this gives us a total current liabilities of 400,000, which can help us in solving the second requirement of this question. Now for the second requirement, as you see, we want to figure out the working capital and the current ratio for a limited company, knowing that current assets for the company are 504,000. So the working capital, we said we're just going to subtract current liabilities from current assets. So we'll say 504,000 minus 400,000, that will give us 104,000 working capital. Whereas the current ratio, we're going to divide current assets by current liabilities. So we will say 504,000 divided by 400,000, that will give us 1.26. Now let us move on to the third and last learning objective for today's lecture. We're going to explain how to account for payroll. Now, payroll pertains to both salaries and wages. Salaries are managerial, administrative, and sales personnel. These are given out usually monthly or yearly, whereas wages are store clerks, factory employees, and manual laborers, and these are usually calculated as a rate per hour. Now, determining the payroll involves computing three amounts: gross earnings, payroll deductions, and net pay. To calculate the gross earnings of a specific worker, all we need to do is to take the total compensation earned by the employee, and that includes any wages or salaries plus any bonuses and commissions. So as you can see here, the computation includes the different types of pay. So here we have regular hours for this worker, which in this case are 40 hours, and the rate for those hours are $12 per hour. That will give us a gross earning of $480. Now we also need to add to that any overtime, bonuses, and commissions. Here we have some overtime of 4 hours, and the rate for overtime, I think it is calculated as 1.6 of the regular hours. So as you can see, it's $18. So multiplying that by the number of hours, that will give us $72. Now we add the two amounts together and we get the total wages of $552. On the other side of this, we also have payroll deductions. So when you want to calculate the gross earnings of an employee, you also need to consider all the deductions that are taken out of their gross earnings to get to their net pay. And these could be different for different countries, but mainly we here have an example for the United States. So they have they have insurance, pensions, and union dues. They also deduct FICA taxes and federal income taxes, the state and city income tax, and any charity that be taken out. Also, they have 401k plans and things like that. So any deductions need to be taken into consideration. Those payroll deductions can fall into one of two categories. They could be mandatory deductions such as FICA tax, the federal income tax, and the state income tax. They could also be voluntary deductions such as charity, insurance, union dues, and pension plans. We mentioned FICA tax and the federal income tax and the state income tax as mandatory deductions. Now, FICA, which is the Federal Insurance Contributions Act, the FICA, but is more commonly referred to as FICA for short, is the Social Security and Medicare tax, pretty much. So it is designed to supplement retirement and cover employees in case of inability to work due to disability or injury, and provide some medical benefits to employees. Now these are pretty much can fall within two groups: the social security taxes, which are usually contributed to by both the employee and the employer, and these are usually fall with a minimum of 6.2% on salary and wages up to 117,000. And the Medicare taxes, which are also contributed to by both the employer and the employee, come in with a rate of 1.45% on all salary and wages without limitation. And these pretty much, all these details are pertained to the United States tax code. For the federal income tax, these are for employers who are required to withhold income taxes from employees' pay. And withholding amounts are based on the gross wages and the number of allowances claimed by the employee. Finally, for the state income tax, this is unique to each state and depends on the legislations within that state. But most states and some cities require employers to withhold income taxes from employees' earnings directly. As I mentioned before, taking or calculating the net pay of a certain employee uh, requires you to figure out their gross earnings and then deduct their payroll deductions. So here, if we have gross earnings of $552 and payroll deductions as illustrated below in the calculation, so we have FICA taxes of $42 approximately, federal income tax of around $24, state income tax $11, United Fund $10, and union dues of $5. And then you take all of these deductions and subtract them from the gross earnings and you get to your net pay figure. Now, some companies use Microsoft Excel to record their payroll, and it would look like something like what's presented for you here in illustration 11-13. So you'll have the company information and then the employee information below, including their social security number, date of birth, gender, and all of these details. And then you will see a table that begins with the period and the total hours, and then shows the gross earnings section coming from the regular hours of that employee, and any overtime or bonuses or commissions would all be included in this section. And then you have the deductions section, which incorporates all the different taxes that we've covered before, plus any United Funds or union dues. And you get the total of the deductions. Then you can simply figure out the difference between the two, which will give you the net amount. You notice also this includes the check number. So this is the check that is issued for the employee to pay him the net amount that should be deposited into his account. Now, the previous table or spreadsheet was for one specific employee. The company would usually also create another spreadsheet to include all of the employees' details in order to manage or in order to calculate how much they're going to need to pay in total for all of their employees. And it would most likely look like what is presented in front of you. Now let's see how do we recognize payroll expenses and liabilities and how do we record them in our general journal. So this illustration is designed to show you how that is done. It says prepare the entry Academy company would make to record the payroll for the week ending January 14th. And you have salaries and wages expense on the debit side, and then you have all the payable accounts or the liabilities on the credit side. And of course, considering that both debit and credit side need to equal each other. And of course, after the company's accountant would recognize the expense and record the transaction we showed in the previous slide, when the salary is actually paid to the employees or the wages are paid to the employees, then the company's accountant would record this payment by debiting the salaries and wages payable, which is the liability account, and crediting the assets account, specifically the cash account. This slide is just designed to show you how a paycheck would look like if the company uses checks to pay their employees, but most companies nowadays just deposit the amounts or do a bank transfer in order to get the salaries and wages to their employees. But if it was paying by paycheck, it would probably look like this. So you have the check at the top with all the details and the information with the amount and the name of the employee signed. And then it would have a what we call a pay slip, which shows the details of the earnings and the deductions for the employee to keep in his records. Let's check out this do-it-yourself exercise together. It says in January, gross earnings in Ramirez company were 40,000. All earnings are subject to 7.65% FICA taxes. Federal income tax withheld was $9,000 and state income tax withheld was $1,000. First requirement is to calculate net pay for January, and second requirement is to record the payroll. So first, we want to calculate the net pay. So we'll take the net earnings, which is 40,000, and then deduct all the deductions starting with FICA taxes. So we'll multiply 40,000 by 7.65%, which is the rate, and also subtract the federal income tax of 9,000 and subtract the income tax or the state income tax of 1,000. So doing the calculation, we will get a net pay of $26,940. Now, how do we record this on the general journal? Of course, just like we showed before, we're going to debit salaries and wages expense for 40,000 and then credit all the deductions, starting with FICA taxes payable, 3,060, federal income taxes payable, 9,000, state income taxes payable, 1,000, and salaries and wages payable, the remaining amount, which is $26,940. Now, on the other side of this, employers also need to pay payroll taxes. So the payroll tax expense results from three taxes that governmental agencies levy on employers. And these taxes are FICA taxes, which usually is the same rates and maximum earnings as the employees, federal unemployment tax, and state unemployment tax. Now for FUTA, or federal unemployment tax, the rate is 6.2% of the first $7,000 of taxable wages, and the employers who pay the state unemployment tax on a timely basis will receive an offset credit of up to 5.4%. Therefore, the net federal tax rate is generally 0.8%. Now, please bear in mind that these all pertain to the United States of America, and it usually is different from one country to another. The last one is the state unemployment tax, or SUTA, and the basic rate is usually 5.4% on the first 7,000 of wages paid. Paying this, as we mentioned before, will drop down the federal unemployment tax for the employers. So knowing this, the company needs to compute the salaries and wages that they are going to pay for their employees, and based on these numbers, they need to also figure out what is the federal unemployment tax and the FICA taxes and the state unemployment tax. Here is an illustration to see how a company would record the employer payroll taxes. The illustration says Academy records the payroll tax expense associated with the January 14 payroll, the one we covered in illustration 11-14, with the following entry. Use the following rates: FICA 8%, state unemployment 5.4%, and federal unemployment 0.8%. So now we're going to debit payroll tax expense with the total amount and credit all the three different amounts and add them together to figure out how much is the expense exactly. So for FICA tax payable, we're gonna multiply 17,210 by 7.65, and that will give us the FICA tax payable. And then for federal unemployment tax payable, we're going to multiply 17,210 by 0.8%. That will give us $137.68. And finally, for the state unemployment tax, we said that the rate is 5.4%. And that means we're going to take 17,210 and multiply it by 5.4%. And that will give us 929.34 cents. Here's a quick review question. It says employer payroll taxes do not include. Now remember we mentioned 3 types of taxes that are included in the employer payroll tax, and those were federal unemployment taxes, state unemployment taxes, and FICA taxes, which means that the one that is not part of this group is the federal income tax. So the correct answer here is C. This slide shows an article from the Wall Street Journal that was published on August 9th, 2010, under the title, Why I'm Not Hiring. Feel free to pause the screen or pause the video and give it a read. We learned how to record payroll and payroll taxes. Now let's see how these payroll taxes are filed and remitted. Now, you should know that companies must report FICA taxes and federal income taxes withheld no later than 1 month following the close of each quarter. Now, the companies generally file and remit federal unemployment taxes annually on or before January 31st of the subsequent year. Companies usually file and pay state unemployment taxes by the end of the month following each quarter. Employers must provide each employee with a wage and tax statement form by January 31st. Again, just to remind you, these are United States of America rules and regulations, and they do not necessarily apply exactly for other countries. This slide shows you the W-2 form that we just mentioned in the previous slide, which companies use to file their payroll taxes. Now finally, to the last point of today's lecture, we'll talk a little bit about internal controls for payroll. Now, internal controls are put in place when it comes to payroll to safeguard company assets against unauthorized payments of payrolls, and of course to ensure the accuracy and reliability of the accounting records pertaining to payrolls. This slide shows some internal control measures that are put in place for various different functions. So for payroll function of hiring employees, we have an internal control feature where the Human Resources Department documents and authorizes employment. And the fraud that is prevented by this measure is fictitious employees are prevented from being added to the payroll. Another function is timekeeping. If you have ever worked in different works, usually they put like a machine to that you could, or a card punching machine or a fingerprint machine to check what time the employees make it to work and what time they leave. So the internal control feature here that supervisors monitor hours worked through time cards and time reports. And the fraud that is prevented by this measure is that employees are not paid for hours that they haven't actually worked. Another function is preparing the payroll. And the control feature here is that 2 or more employees need to verify payroll amounts, and the supervisor needs to approve. And the fraud that is prevented by this measure is that payroll calculations are accurate and relevant. The last one is actually paying the payroll, and the internal control feature here is the treasurer needs to sign and distribute pre-numbered checks. And the fraud that is prevented is that the checks are not lost, misappropriated, or unavailable for proof of payment. Endorsed check provides proof of payment. Finally, we will end the lecture with this do-it-yourself example for employers' payroll taxes. The exercise says on in January, the payroll supervisor determines that gross earnings for Halo Company are $70,000. All earnings are subject to 7.65 FICA taxes, 5.4% state unemployment taxes, and 0.8% federal unemployment taxes. Halo asks you to record the employer's payroll taxes. So in order to record this, the entry for the employer's payroll taxes would look like this. We're going to debit payroll tax expense for $9,695. On the credit side, we will include three different accounts: FICA taxes payable, which is at the rate of 7.65%, and federal unemployment taxes payable, which is 0.8%, and the state unemployment taxes payable, which is 5.4% out of the 70,000, of course. So we will end up with a payroll tax expense of 9,695 and a FICA taxes payable of 5,355, federal unemployment tax payable of 560, and state unemployment tax payable of 3,780. That was it for today's lecture. I hope you guys enjoyed it and learned the how to deal with current liabilities and with payroll and payroll taxes. Thank you all for listening, and I would be happy to take any questions that you might have.